What's up, guys? Welcome to episode 7 of Cash and Confidence, where we talk money, market power, and respect. I am your host, Mo Money, per usual. Episode 7 is crazy. We only have 3 more episodes left in this season. And then season 2 is going to be like straight fire. Seriously, y'all thought like this season, or maybe y'all didn't think it. I don't know. I wouldn't know because you haven't left me a comment or liked or subscribed or rated 5 stars preferably. So yeah, if you haven't, go ahead and do so. Anyways, I do really appreciate you guys for listening. For those who have commented, I encourage the feedback because I want to know what the people want to hear. I want to know what you guys want to learn about. I hope and encourage that you are following along on each episode because I'm literally giving you the flow. So if you're going with the flow, you're on your way to making money. Yeah. Guys, I am exhausted. I didn't even know where I was going to go with that, but I can tell you firsthand that I'm very exhausted. I'm actually going to New Orleans this weekend. I'm pretty excited about it, but I am a last minute packer. Yep. And so I have not packed fully yet. I got a little bit done, but I need to get more. Anyways, that's enough of yapping. I want to give a recap of last week's episode. We talked about Roth IRAs, and how they are a retirement investment account. It is the container, and then the contents that you put in there are dependent on what you want to invest into. And so to dive deeper on that, this week's episode, I do want to talk about portfolios on how what you're structuring in your investment accounts, like what it's saying about you, basically. So this week's episode is going to be called Your First Investment Portfolio Made Easy. So what is a portfolio to start? A portfolio is going to be like basically a bunch of your investments. It's a collection of your investments, your assets, and it's almost like your money's job description, if you will. It's giving you a breakdown of what your money is doing. And so usually you want to have about 2 to 5 types of assets. For those who aren't familiar, assets are appreciating, whereas liabilities depreciate. So you want to have assets that are continuously making you more money or building equity, like homes. And just think of it as like your grocery card or your playlist. You know, what you put in determines your results. So if you're putting in bad stuff, then you're going to be living an unhealthy life if that's what you put in your shopping cart. So I definitely want to make sure that we break down what to put in and also like how to go about putting them in. So a quick little analogy that I created for you to think about investing is like a smoothie, right? So index funds would be like your banana base because I feel like smoothies are good with bananas. Am I right? They're steady and essential, just like an index fund. And all of these words, by the way, can be found in the Wealth Starter Kit, which can be found on the archives for the VIP newsletter. So be sure to subscribe. I'll put the link in the bio for you. And then your ETFs are going to be like your strawberries and your blueberries. You know, they're going to add that flavor and variety to the smoothie. Then you have the individual stocks, which are like the chia seeds or the almond butter. That's going to give you the powerful, higher risk flavor, or they don't really have flavor, but you know, I guess almond butter does. But yeah, it gives you that more powerful nutrients that you need or more powerful investments. Then you have crypto, which is like your shot of cayenne pepper or ginger. That's spicy and risky, right? And only add it if you can handle it. Because crypto can be a lot. It's very volatile, especially right now in this economy. So that's just a quick little way for you to like kind of visualize how your goals will be set up within your portfolio. So some sample starter portfolios I want to break down as like beginner, moderate, and advanced. Or even we could say lower risk, moderate risk, and higher risk, right? So your portfolio one is going to be your lower risk. That's like your ultra beginner. That's 80% index fund, like S&P 500 total market, and then 20% ETFs. So you're starting off light. You just have like those 2 assets. Portfolio 2 is going to be your more moderate version. 60% index funds. You're going to have 25% ETFs. You're going to have 10% individual stock and 5% crypto. So you're throwing in a little bit of cayenne pepper, giving it a little bit of spice, but at the same time, not going too heavy on that, right? And then you've got your portfolio 3, which is your more advanced option. And that's going to be like 40% index fund, 30% individual stocks, 15% ETFs, and then 15% REITs or crypto. REITs are like the real estate investing without actually owning real estate. So these are your more riskier options, but it's a great way for you to get those higher risk and higher rewards. But you can also start off, moderate or start off smaller. I have my account personally is more moderate. And then I go a little bit heavier on the trading side of things from that investing. But my overall portfolios, it is higher risk, but I would say that my Alinea account at least is more moderate. So just kind of pick what works for your lifestyle, right? And, you can build on in your Roth IRAs and in these different accounts, like Alinea, I just said, Public, Fidelity, you can build them within those accounts. So how to pick the right mix for you, break it down into a couple steps. So think about your risk tolerance, right? Risk management is so important with not just investing, but trading and just everything in life in general, your budgeting, all of that. You got to think about how spicy are you willing to get? How much cayenne are you willing to throw in there to get a good reward? Think about your goals. Are you building for retirement? Are you building to buy a house? Are you building for early retirement? Think about those goals as you're setting up your portfolio, right? And then think about a budget for sure. That goes hand in hand with your risk management, but also just seeing if $10 a month works, let's say for 3 months, and then reassessing quarterly to a point where if you don't want to do $10 anymore, maybe you have enough room in your budget to bump it up. You want to go 20 or 50. And then just keep reassessing from there and always make sure you're adding that money. Don't just put $10 in and let that build over time. It's going to take forever. Try to take just those $10, $20, $50 out of your check to invest. Do that. I mean, there's no perfect portfolio, but you have to align it with your life and with your timeline and your comfort level. So I guess that's going to create the perfect one, right? Yeah. So now I want to give a little detail of how to set up your accounts, let's say for individual stocks. And I want to break this down more into a full episode. But for right now, let's just give a little breakdown. So the step 1 that you want to do is start with what you know. If you use companies like Apple, Nike, Amazon, or whatever it is that you believe in, look at them. Look at what they're doing. Would the customer buy this if the hype died down? Are people still going to be buying iPhones? Which we know they are. Are people going to still be shopping on Amazon? Amazon has gotten a lot of slack as of recently, but do you still see Amazon pushing through? Nike has always been a thing, and I think it will always be a thing, but you have to do your research on is this something that can produce longevity, or lucrative? Your investments basically need to match your lifestyle and your values and your habits, right? So step 2, you're going to do a 3-minute company check. So you're basically just going to look on apps like Public, Yahoo Finance, or Google. You're going to see what the company is actually doing, what they've done. You're going to look at the overall news of them. How's the vibe going with them? Are you seeing bad news about them, like layoffs? Are you seeing good news about them? Have they done something for the community or things that are creating more hype? Are they profitable? Checking their profitability. A lot of these companies release their profits quarterly or annually. and be sure that you're looking at a 5-year chart. Don't just look at the here and now. If you want longevity, you need to see what the company has been producing. Has this company been consistently profitable? Has this company had an incline in their profitability? Have they had consistent good news? Think about all those things and look from the past 5 years, not just 1 month, right? And then step 3, you're going to ask yourself these quick questions. So you want to ask yourself, do I believe this company will be around in 10 years? Are they solving a real problem, or are they trend proof? Would I buy more if the price dipped? And then if you wouldn't buy it on sale, don't buy it at full price either. And that's not really a question, but yeah, if you wouldn't buy it on sale, if I'm not going to buy this on sale, then I'm not going to buy this at full price either, because that doesn't make any sense, right? So I would say just wait for the market to pull back. Again, all things we can talk about later, but look at your charts once you're become familiar with the charts, and if you see that the market has been consistently inclining for a long period of time, understand that it could take a little dip, but it just depends on the company. And you kind of have to see what the trend is of that market. So yeah, those are like my quick little steps on how you can begin researching for your investments. Some tools to help you get started. You definitely want to use these different companies that I've been talking about to do your research, but public is going to be good for like your fractional shares and your ETF options. You can research more on there as well. Alinea is definitely like value-based playlist. So for me, I have Alinea, and Alinea kind of auto invests for me. It definitely does. They're going to invest more so into the index funds, and then they invest in like smaller little things like bonds and stuff like that. But it does give you helpful advice on how to invest. They have knowledge on there as well, which I love. Fidelity is going to be like full-fledged Roth IRA access. You'll be able to learn more about Roth IRAs and those investment accounts. Morningstar and Yahoo Finance are great for researching. So Yahoo Finance is a really good one. Just go on there. If you have TV, you can watch Bloomberg. Sometimes I'll just turn Bloomberg on in the background, and you can hear what's going on with each company. And specifically, it talks to investors. So, definitely be sure to subscribe to the VIP newsletter, because I am going to drop a free portfolio guide in, I almost said next week, but it's this week's newsletter. Sorry, when I record a week in advance. So I'm going to drop a portfolio guide for you guys in the newsletter. So definitely make sure you're on the list. You don't want to miss out for that. So guys, you don't need to be a Wall Street analyst, right? You don't need to be a professional at this. You just need to be a curious and intentional investor, so that way you can build your money. Don't just go off of the hype of TikTok and social medias and things like that. Like, literally do your research. And in an episode before the season is up, I do want to talk about, like, more in depth, probably next episode, how to really invest, how to really break down a stock. Whether you're looking for dividends, penny stocks, fractional shares, the full stock, all of that. So just start with what you understand, learn as you go, and then let your portfolio evolve with you. So whatever you feel comfortable with investing into, invest there, and if you don't feel like adding fire onto there, then invest in something else that you do want to add fire onto. If you see something is doing really well, add more fire to it. Let it build up. And again, we'll talk more about crypto, because that is a really, really risky market to be in, as is like Forex and any market really, but definitely build a portfolio that has diversification. Diversity is what's going to help you build money, because when one thing is not performing at its best, you have other aspects of your portfolio that are, and that's what balances it out, right? So anyways, guys, that is the end of episode 7. Quick episodes these days, because your girl is tired, but I'm doing it. Okay. I appreciate you guys so much for listening. Be sure to subscribe as usual. And until next time, guys, namaste.